Silver's price is finally yelling, but the spread is what's been screaming for weeks, and that's why this move has the potential to turn parabolic faster than most people are psychologically prepared for. Because the second silver starts ripping, the whole machine flips into defense mode. Not because they hate silver, because violent trend moves break narratives, they break positioning, and they break risk models. And if you understand the hidden mechanism underneath this tape, what's actually tightening where the pressure is building, and which levels force participants to act instead of having an opinion, you'll stop reacting like a tourist and start watching it like a market. Right now, silver isn't just up. It's repriced. It's one thing to grind higher in a calm uptrend. It's another thing entirely when price starts moving in discontinuous steps. Clean pushes, shallow pullbacks, then another push. Like the market is hunting for liquidity and not finding enough of it. That's the signature. And you can feel how fast sentiment flips. One day it's industrial metal. The next day it's speculative frenzy. And somewhere in the middle, the same people who ignored it at $80 are suddenly screaming bubble above 110. That is not analysis. That's positioning talking through a headline. Here's the first rule of parabolic markets. The public narrative always arrives late, and it always tries to explain a mechanical process with a moral story. Greed, fear, mania. It sounds smart because it's emotional and familiar, but it misses the actual engine. And when you miss the engine, you get manipulated by the exhaust. So let's set the conflict clearly. If silver accelerates, you're going to be fed two kinds of messaging at the same time. The first is the it's over messaging. Overbought, unsustainable, retail frenzy, this can't last. The second is the it's safe to ignore messaging. It's just a spike, it's just geopolitical noise, it's just a dollar move, it's just a one-off. Both are designed to do the same thing, keep you from holding a coherent plan long enough to benefit from the setup. And that's where the real pressure starts, because the people who can't be shaken out by volatility are the ones who end up with the best entries, the best exits, and the clearest red on what's real. Now, I'm going to give you levels, real levels that matter this week and into the next 1 or 2 weeks, and I'm going to tie those levels to mechanics, not vibes. But before we even go to the chart logic, you have to understand what the chart is sitting on top of, because the chart is the shadow, the body is market structure. The first honest clues in a metals move are never the loudest headlines. They're the boring, ugly details. How the front month trades relative to the back months, what the spread is doing, whether availability tightens, whether delivery urgency shows up, whether regional prices begin to diverge, whether the market starts charging you for immediacy. And that's the part most people don't watch because it isn't as fun as a green candle. But it's the part that tells you whether you're seeing a paper rally or a stress rally. Here's the hidden detail that reframes everything. The curve, not the spot price, the curve. When the front end of the curve gets bid aggressively, when the market stops paying you to wait and starts charging you to wait, that's not emotion. That's inventory preference. That's the market saying, I value metal now more than metal later. And in commodities, that is a red alert. Because normally, in a stable, well-supplied commodity, the structure leans toward contango. Future prices above spot, storage, and carry costs embedded. When that relationship flips, it's not just a technical curiosity. It's a signal that immediacy is scarce. And scarcity doesn't need a conspiracy to move price. Scarcity just needs time. If you have any kind of persistent draw, any kind of settlement urgency, any kind of global friction in moving physical material around, the front end tightens first. The spread tells you before the spot price becomes obvious. The spread is the lie detector. And if you get that one point, you stop being confused by why is silver doing this? And you start asking the only question that matters. Who is being forced to do what, at what price, and on what calendar? Because parabolic moves don't pick random weeks. They pick moments where the calendar corners participants, month end, options expiry windows, delivery windows, liquidity pockets, risk managers tightening collateral, funds rebalancing, dealers hedging. And when those collide with a tight front end, you don't get a gentle trend, you get discontinuity. You get air pockets, you get gaps, you get the kind of tape that punishes both the overconfident bear and the underprepared bull. And that's not the part that matters. What matters is that this kind of tape rewards the person who has already decided what levels mean trend intact versus trend broken. So let's talk levels, but let's do it the right way, not as mystical numbers, as zones of obligation. In silver, round numbers matter because human behavior clusters around them, and options markets cluster around them, and risk models cluster around them. When price crossed $100, it wasn't just a cool number. It was a line in the sand for hedging flows and institutional attention. Above $100, you drag in two kinds of buyers. momentum allocators who are waiting for confirmation, and hedgers who suddenly realize their tail risk isn't theoretical anymore. And you also trigger two kinds of forced behavior. Shorts, who have to reduce exposure because their drawdown profile becomes unacceptable, and dealers who have to dynamically hedge options exposure as spot accelerates. This is where gamma can turn a normal rally into something that feels like it has gravity reversed. Here's the clean explanation. Options dealers often sit on the other side of your calls. When people buy calls, dealers are short those calls. As price rises, the delta of those calls increases, meaning the dealer's exposure becomes more sensitive to price. To stay hedged, the dealer buys the underlying as price rises. That buying pushes price higher, which increases delta further, which forces more buying. That feedback loop is reflexivity. It's not sentiment, it's math. And if the market is thin, if liquidity thins, if order books aren't deep, this hedging flow can push price through levels faster than fundamental investors can process it. And that's why, in a parabolic setup, levels aren't support and resistance like a textbook. Levels are strike zones. They are places where hedging intensity changes, where stop clusters live, where margin calls trigger, where a retest either relieves pressure or rebuilds it. Because if this one level breaks, the math changes. So here are the zones I care about right now in the simplest possible way. First, the psychological and structural zone around $100. That's not just a number, it's the new regime marker. If silver is above $100, the market's reflex is to treat dips as buyable until proven otherwise. If it falls back below $100 and can't reclaim it quickly, that's your first warning that the move is transitioning from trend into blow off and fade. Not guaranteed, not instant, but it changes the posture. Second, the $110 zone. This is a belief zone. You don't grind above $110 by accident. Above $110, people who hesitated start chasing because they can't stomach missing it. Above 110, media attention spikes. Above 110, volatility starts to become a story. And that's exactly when the market will try to punish emotional participants with whipsaws. But if silver holds above roughly $110 on a daily closing basis, especially if dips into that zone get bought quickly, that tells you the market is accepting higher prices, not just spiking through them. Third, the $115, $120 zone. This is where parabolas either stall or evolve. If price pushes into the upper teens and then can't consolidate, if every attempt to breathe gets sold hard, that can be the start of a sharp shakeout. But if price pushes into that zone, pulls back in a controlled way, and then reclaims it, especially if the reclaim is fast, that's when continuation squeezes become more likely. Because consolidation at higher levels is how markets build a platform for the next leg. That's where the real pressure starts. Fourth, if the market starts printing beyond $120 with speed, you immediately start thinking in air pocket terms. That's not because $120 is magical. It's because once a commodity breaks into a fresh volatility regime, the next resistance is often less about chart history and more about the pace of forced flows. That's when you see $125, $130 as magnets, not because they're guaranteed targets, but because they're where behavior clusters. If it gets there fast, you watch whether spreads stay tight, whether pullbacks are shallow, and whether the market keeps paying for immediacy. The next detail is what flips the whole setup. The curve has to confirm the move. If the curve relaxes while spot spikes, that's a warning. If the curve stays stressed while spot rises, that's fuel. Now the supports, because this is where most people get wrecked. In a volatile metal, the thesis can be correct, and your timing can still be wrong. Price can whip around violently, even if the underlying pressure is real. That's normal. The market will use those whips to steal your decision-making. The first support zone is the most recent acceptance area, roughly where the breakout accelerated. In this tape, that often sits around the low 110s if we're currently trading in the mid to upper teens. If silver dips into the low 110s and buyers show up quickly, meaning you see fast recoveries, you see sellers fail to press it lower, that's a bullish signal. Not because it's pleasant, but because it shows the market is defending the new higher range. The next support zone is the prior surge platform around $103 to $105. That zone matters because it's where the market proved it could hold 3 digits without collapsing. If silver retraces into that area, it will feel terrifying. It will feel like the move is over. Headlines will be screaming crash. That is exactly when you need structure. If that zone holds and price starts building higher lows again, that's scenario 1, controlled pullback and retest. It's boring, it's annoying, but it's often how bigger moves stay alive. Below that, you've got the mid to high 90s. Call it $95, $90 to $98. If silver loses that area and can't reclaim it, that's where you start taking parabolic thesis down a notch. Because a parabolic move doesn't need to be straight up, but it does need the market to maintain a higher price regime. Losing the high 90s after breaking $100 is how you transition from new regime into false breakout, and psychology. And false breakouts in a hyped market are how people get emotionally obliterated. So here's the two scenario lens, and you need to burn this into your brain because it keeps you sane. Scenario 1, the market does a controlled pullback and retest. That means silver pulls back, sometimes sharply, toward $110 or $105, but it doesn't cascade. It stabilizes. It starts putting in higher lows. It starts rejecting lower prices. The curve and spreads calm but don't collapse. Physical premiums don't suddenly evaporate. And the next push higher comes from a base, not a spike. This is the healthiest version because it resets funding stress and shakes out weak hands without breaking the structure. Scenario 2, continuation squeeze. That means silver barely gives you a dip. It consolidates briefly, then rips again. It gaps. It runs, stops. It accelerates into round number magnets like $120 and $130. This is the exciting version. And it is also the version most likely to punish you with sudden reversals, because squeezes don't end politely. They end when forced buyers are exhausted or when the market finds supply at a level where sellers can finally press it. And you won't know you're at that point until after it happens. That's why you don't bet your identity on scenario 2. You watch for confirmation and you respect the invalidation. Now, let's layer in supply chain reality, because this is where a lot of lazy takes die. People will say, high price fixes high price. And in some markets, that's true quickly, not here. Silver supply is not a faucet you turn on. A meaningful portion of silver production is as a byproduct of mining other metals. That means silver supply doesn't respond cleanly to silver price. It responds to the economics of the primary metal, the production plans, the capex cycles, and the refining capacity downstream. Even if price is screaming, new supply takes time. Permitting, expansion, ore grades, processing, refining, none of that flips on in a week. And that's the part that matters, because a parabolic move is often a race between demand urgency and supply response. In silver, supply response is slow and awkward, which means demand shocks can have outsized short-term effects. Then add logistics. Even if there's silver somewhere, it's not automatically deliverable where it's needed. Different forms, different bar sizes, different locations, different settlement systems, different frictions. The market can be well supplied in theory and still tight in practice at the point of delivery. That's why you can have a world where spot is screaming while people argue online about total above ground silver. Total above ground is not the same thing as deliverable inventory at the right place, at the right spec, at the right time, at the right price. And the market trades the bottleneck, not the total. Now bring in global arbitrage. If one hub is bidding aggressively and another hub is less urgent, metal flows. But those flows are not instantaneous and not free. They require financing, transport, insurance, and time. If there's a regional premium that persists, it means arbitrage is constrained. That constraint is itself information. It tells you that the market is not simply efficiently smoothing everything out. It tells you stress is real enough that the usual equalizers are lagging. Institutional flows matter here too, and not in a mystical way. In a market like silver, the easiest way for large pools of capital to express a view is through financial products. When that on-ramp opens and sentiment turns, flows can become a magnet. And the key is this. Flows can impact the physical market indirectly because they change hedging needs, they change how inventory is managed, and they change the psychology of available supply. Even if you don't want to overstate it, you can't ignore that. When financial demand rises quickly, it changes the ecosystem. Dealers hedge, market makers adjust, borrow rates, leases, and forward curves can react. The entire structure adapts, and that adaptation often shows up first in spreads. And spreads are the most underappreciated truth serum in this entire story, because spreads aren't a headline. Spreads are what the professional market watches when it wants to know whether a move is solid or flimsy. A flimsy move is one where spot spikes, but the curve relaxes and the market starts offering you a discount for immediacy. A solid stress move is one where spot rises and the front end stays bid, where the market still values now more than later. That's not a guarantee of continuation, but it's the difference between a sugar high and a structural repricing. Now, let's address the counterpoints, because this is where you keep your credibility and your money. Yes, silver can plunge even after a massive rally. In fact, sharp pullbacks are part of the process. Some of the biggest bull markets in history are full of terrifying corrections that shake out anyone who doesn't have a plan. That's the price of admission. Yes, a macro shock can slam precious metals. If the dollar spikes violently, if real yields reprice higher quickly, if there's a sudden liquidity event where funds sell what they can, not what they want, silver can get hit. It's a leveraged sentiment asset in the short term, even if it's a monetary metal in the long term. That's why you don't confuse bullish with it can't drop. It can drop, it will drop. The question is whether drops are being bought and whether structure holds. Yes, exchanges can raise margins. In explosive moves, margin requirements often rise. That forces levered participants to reduce exposure. That can create sudden downdrafts. That's not manipulation. That's risk management. It's the system trying to slow the fire. And it often creates exactly the kind of violent volatility that makes retail participants panic at the worst time. And yes, recycling can respond at higher prices. But recycling is not a magic switch either. It responds with a lag, and it's constrained by collection and processing. It might matter over months. It doesn't usually neutralize a tight front end in a week. So the way you stay sane is by separating trend signal from noise. Trend signal is what happens on closes, on retests, on acceptance and rejection at key zones. Noise is intraday chaos designed to trigger your emotion. If you measure the market by your feelings, the market will measure you by your liquidation. Here's the viewer psychology shield, and I want you to actually use it, not just nod along. Volatility will try to manipulate you through timing. You'll see a brutal red candle right after you buy. You'll see a euphoric green candle right after you sell. Headlines will appear exactly when the move is most emotionally intense. Crash at the low. Moon at the high. That's not because the media is evil, it's because attention follows price. But you are not here to follow attention. You are here to follow mechanics. So you decide in advance, what is your thesis, what confirms it, what weakens it, and what invalidates it. Confirmation looks like holding above $110 after tests, or reclaiming it quickly if lost. Weakening looks like repeated failures to reclaim $115, $120 after rejection, or a curve that relaxes while spot spikes. Invalidation looks like losing $100 and failing to reclaim it, or cascading below the mid to high 90s with no meaningful bounce, especially if spreads normalize and urgency evaporates. Those are examples, not commandments. The point is that you need pre-decided lines so the market can't rewrite your brain in real time. Now, what comes next in the next 5 to 10 trading days? Watch this sequence, because sequence matters more than the headlines. First, watch how silver behaves around $110 on pullbacks. Not the first touch, the reaction. Does buying show up quickly? Do sellers fail to press? Does it snap back? That's the acceptance test. Second, watch the $115, $120 zone for consolidation versus rejection. If the market can't hold any gains above it and keeps slamming lower, that tells you there's supply or profit taking heavy enough to slow the move. If it holds and builds, it's a platform. Third, watch the round numbers like $120 and $130 if momentum continues. Not because they're guaranteed targets, but because they are where hedging intensity and psychology can shift. The move can accelerate into them and then reverse violently. Or it can slice through them like they weren't there if the forced flow is strong enough. The way it behaves around them tells you what kind of market you're in. Fourth, watch the curve and the spreads. Are nearby contracts staying bid relative to deferred? Is the market still charging for immediacy? If that stress remains while spot rises, it suggests the underlying tightness hasn't been relieved. If it relaxes dramatically, it can signal that the squeeze pressure is venting, even if spot is still high. Fifth, watch for the calendar traps. End-of-month dynamics can change how funds rebalance and how books get cleaned up. Option expiries can change gamma exposure quickly. Delivery windows can shift urgency. Thin liquidity, especially around weekends or after major policy events, can exaggerate moves. In a market like this, gaps are a feature, not a bug. You don't need to predict the gap. You need to respect that it can happen and size your risk so a gap doesn't turn your plan into a disaster. And let's talk risk management like grown-ups for a second, because this is where trust is built. You can be right and still get hurt if you are oversized, overlevered, or emotionally attached. Silver can move like a chainsaw. It can rip your face off both ways. The goal is not to win the internet. The goal is to survive long enough to let the market pay you for being early and disciplined. That means you think in time horizons. A trade horizon is different from an investment horizon. A parabolic move is different from a structural bull market. Don't mix them. If you're trading, you respect stops and volatility. If you're investing, you respect drawdowns and you don't confuse a pullback with betrayal. The market doesn't owe you a smooth line. Now, I'm going to say something that will save you a lot of pain. The most dangerous moment in a parabolic setup is not the top. It's the first major pullback after you've mentally declared yourself right. That's when people stop managing risk and start defending ego. That's when they turn a position into an identity. And then the market uses a violent shakeout to separate them from their conviction at the worst possible price. Don't do that. Keep it mechanical, keep it humble, keep it structured. So what's the real payoff here? The payoff is that you stop being surprised by the behavior. If silver is in a stress-driven repricing, you expect violent continuation and violent pullbacks. You expect narrative whiplash. You expect the same commentators to flip from ignore it to it's a bubble with no shame. You expect margin and risk controls to tighten. You expect dips to feel like endings. And you expect the real story to show up in the boring details: spreads, term structure, availability, and how price behaves at obligation zones. If you take nothing else from this, take this. The parabolic move doesn't start when everyone is excited. It starts when the market structure stops agreeing with the narrative. And once the line breaks, the market can't unsee it. If you're still here, you're not chasing hype. You're tracking mechanics, and that's the whole edge. Most people will get chopped up because they'll treat this like entertainment. They'll buy because it feels exciting and sell because it feels scary. They'll confuse noise with signal and then blame manipulation, when what actually happened is that volatility did its job. Stay disciplined. Watch $110 as the acceptance line. Respect $100 as the regime marker. Treat $115, $120 as the platform test. And if we accelerate beyond $120, don't get hypnotized by the candle. Watch whether the market can hold those gains and whether the curve stays stressed. If the front end keeps getting bid, pressure is still building. If the curve relaxes while spot screams, the move might be running on fumes. And if you want to run with a crowd that thinks like professionals instead of tourists, stick close to the people who can explain what would make them change their mind. That's the real tell. Not confidence, not volume, not vibes. The ability to name invalidation without flinching. Because in the next week or two, silver is going to try to do the same thing it always does in these moments. Shake you out, lure you back in, and test whether you're watching price or watching pressure.